Let's dive right into this explainer, guys. We're going to completely demystify how a share actually travels from a locked company vault all the way to your personal Demat account, step by deliberate step. We stare at these flashing red and green numbers on our screens all day, but we often totally forget the actual physical mechanics of what's happening behind the scenes. So today, we're going back to ground zero. We are going to break down the entire life cycle of a share and really get into the nuts and bolts of how stock exchanges match buyers and sellers. Here's our roadmap for this explainer. First, we'll look at the private company vault. Then we move to the IPO and primary market. Third, entering the secondary market. And finally, we'll wrap up with the XYZ Coffee shop order book. All right, Section 1, the private company vault, right before the public market. Imagine a business, let's call it XYZ Limited, as a fully private company, completely untouched by the public exchange. Let's say XYZ has created exactly 10,000 shares. That's their total share capital. Now, at this ground zero stage, these shares are definitely not trading on any screen yet. No way. They're locked up tight with the founders, the CEO, and the promoters. There are zero public buyers right now, and the only potential seller is the company itself. It's just this entirely closed little ecosystem. Moving on to Section 2, the IPO and primary market, opening to the public. Okay, so XYZ needs funds to expand, right? So they decide to raise capital by doing an initial public offering, or IPO. And this brings us to an absolutely crucial difference between the two markets you hear about all the time. In the primary market, during that IPO phase, when you and I buy shares, our money goes straight into XYZ Company's actual bank account. It funds their growth. But once those shares are officially listed and enter the secondary market, the company steps completely out of the picture. From that point on, the cash just flows directly between retail investors buying and selling to each other. So, how do those shares actually reach you in the first place? Well, XYZ packages its 10,000 shares into 100 lots, say 100 shares per lot. Retail investors across India log into their broker apps, like Zerodha or Dhan, and apply for these lots. After that, a designated registrar steps in, collects all those bids, and runs the allotment process strictly based on SEBI's rules. The final outcome here depends entirely on public demand. If the IPO is fully subscribed, meaning all 100 lots are applied for, boom, all 10,000 shares are allotted and hit individual Demat accounts. These shares become what we call the free float. They are freely available to trade. But if it's only partly subscribed, let's say only 70 lots get applied for, well then only 7,000 shares become free float. The rest just stay locked up with the promoters. Now let's hit Section 3, entering the secondary market. We're demystifying the order book. So, XYZ is listed, shares are sitting in retail Demat accounts, and the morning bell rings. Behind the scenes at the NSE or BSE, there is this insanely powerful computer system called the matching engine. Its entire purpose in life is to maintain the limit order book. It meticulously sorts all the buyers, which we call bids, by prioritizing whoever is willing to pay the absolute highest price. On the flip side, it sorts all the sellers, the asks, by prioritizing whoever is willing to sell for the lowest price. It's essentially a continuous ultra-high-speed auction. Look, treats don't just happen by magic, right? They only actually happen when we reach a state known as a crossed market. What does that mean? It just means a buyer has finally stepped up and said, okay, I'm willing to pay a price that is equal to or greater than what a seller is asking for. Until those prices cross, the orders just sit there staring at each other. Now, the exact second that cross-market happens and a match is finally made, a very important number is born, the LTP, or last traded price. When you look at your screen and see XYZ trading at, say, 100 rupees, that's just the LTP. It literally just tracks the exact price of the single most recent successful match. That's it. Nothing more, nothing less. And here is the golden rule you really need to remember. Who actually determines that final trade price? Well, the market is split into makers and takers. A maker is the person whose order was already resting patiently on the order book. A taker is the person with the new incoming order that matches it. The golden rule is this. The trade always executes at the maker's price. The patient person gets their way every single time. Which brings us to Section 4, the XYZ Coffee shop. Let's do a live trading simulation to make this super clear. To make these abstract concepts crystal clear, let's step away from the digital screens and walk into a local spot, the XYZ Coffee shop. In this analogy, every coffee token is one share of XYZ stock. We'll assume every single customer wants to buy or sell a standard block of 100 tokens, and the shop owner, We'll call him Uncle. Uncle is going to be our manual matching engine, diligently writing down every single order on a chalkboard as people walk in. So it's early morning. 3 sellers stroll in, person A, B, and C. They tell Uncle they want to sell their tokens for 9 rupees, 10 rupees, and 11 rupees. So Uncle writes this down on the ask side of his board. But right now there are absolutely 0 buyers. And since there are no bids, no trades can happen, obviously. The LTP is completely blank and our trading volume is sitting at 0. But then, suddenly, the door swings open and person E walks in. He really wants tokens and says, "Uncle, I will buy 100 tokens and I'm willing to pay up to 12 rupees." Uncle immediately looks at his board. His best, meaning his lowest, asking price from a seller is 9 rupees. Because person E's 12 rupee bid is higher than that 9 rupee ask, boom, we have our very first crossed market. Uncle instantly executes the trade. Remember our golden rule from earlier? The trade always happens at the maker's price. Person A was patiently resting on the book at 9 rupees, so person A sells, person E gets their tokens for 9 rupees, and our very first last traded price is officially marked on the board as 9 rupees with a volume of 100. Now let's see how this builds out. A couple of bargain hunters, person F and person G, walk in and place bids at 7 and 8 rupees. They're just chilling, waiting for a deal. But then person H storms in. He does not want to wait. He just shouts out a bid of 11 rupees. Uncle looks at the board. The best remaining seller is person B, who is asking for 10 rupees. So person H's 11 rupee bid easily crosses person B's 10 rupee ask. Bang! Trade number 2 is executed. And again, it triggers at the maker's price, which was person B's resting ask of 10 rupees. Person H gets his tokens. The LTP ticks up to 10 rupees. And Uncle updates the total trading volume for the morning to 200 tokens. Are you starting to see the pattern here? Next up, person I walks in. Now, he doesn't want to specify a price limit at all. He places what we call a market buy. He basically tells Uncle, "I want 100 tokens right now. I literally don't care about the price. Just give me the best available deal." So Uncle checks the asks. The only seller left is person C, sitting there at $11. Uncle matches them immediately. Because person C was the maker resting at 11 rupees, the trade executes right there. The new LTP updates to 11 rupees, and our total shop volume climbs to 300. Notice how that market order just totally swept up whatever liquidity was sitting there waiting on the board? But as we all know, the market is super unpredictable. A new seller, person K, runs in looking panicked. He urgently needs cash and says he'll sell his tokens for as low as 4 rupees. Uncle looks at his waiting buyers. Person G has been sitting there patiently offering 8 rupees. So person K's incoming ask of 4 rupees easily crosses person G's bid of 8 rupees. Because person G was the maker, the trade executes at 8 rupees. That brings the LTP crashing down from 11 rupees to 8 rupees in just a single trade. And this brings us to the final, honestly, kind of beautiful piece of the market ecosystem, role switching. Those people who bought tokens earlier, they can flip on a dime and become sellers. Like person I, who bought at 11 rupees, decides he wants to cut his losses and places an ask at 7 rupees. This perfectly matches person F, who has literally been waiting patiently to buy at 7 rupees all morning long. They cross exactly on the dot, executing trade 5 and making our new LTP 7 rupees. You know, the fundamental mechanics here never ever change. Whether it's Uncle with a chalkboard in his coffee shop managing a few friends, or the mighty National Stock Exchange processing crores of rupees. It leaves us with a pretty staggering thought to end on. If it takes us this long just to walk through 5 simple trades, how on earth do these exchange matching engines perfectly execute millions of these exact same calculations every single second? So the next time you see a stock price flash red or green on your screen, ask yourself, was it a patient maker or an urgent taker who just moved the market?